In March 1929, Bernard Baruch walked away from $25 million in unrealized gains. In August 1987, George Soros liquidated 30% of his quantum fund at all-time highs. In July 2007, Goldman Sachs began secretly shorting the same mortgage bonds they were selling to clients. If you've ever wondered why billionaires get richer during crashes while everyone else loses everything, this pattern has repeated 4 times in a century, and it's happening again right now. 3 strategies. Not 2, not 5. The same 3 mechanical moves, deployed 6 to 18 months before every major meltdown since 1929. Warren Buffett is sitting on $334 billion in cash. Ray Dalio is warning of a paradigm shift. Bill Ackman just took out the largest hedging position in his career. The pattern is repeating. Market crashes don't arrive randomly. They follow a 6-stage mechanical sequence: extreme valuation, euphoric narrative, peak leverage, triggering event, forced liquidation, capitulation panic. Across 96 years and 4 separate crashes, the same 3 strategies appear in the same order, executed by different billionaires who never coordinated yet all recognize the same signals. Federal Reserve data shows insider selling in Q1 2025 reached $15.7 billion, the highest quarterly total since Q4 2007, 3 months before the financial crisis began. Let me show you how these 3 strategies played out across 1929, 1987, 2008, and are being deployed right now in 2025. Strategy 1 happens 12 to 18 months before the crash. It's methodical, quiet, and always blamed on something else. August 1929. Joseph Kennedy receives a stock tip from a shoeshine boy and realizes when everyone is in, it's time to get out. Kennedy converts his entire portfolio to cash over 6 weeks, publicly claiming tax reasons while the Dow hits record highs. Between August and September 1929, insider selling by corporate executives increased 340% compared to the previous quarter. The Dow peaked September 3rd at 381. Kennedy was fully liquid by September 8th. The crash began October 24th, 49 days later. While shoeshine boys were buying stocks on 10% margin, Kennedy was converting everything to treasury bills earning 4.5%. Spring 1987. Paul Tudor Jones spends months studying the 1929 crash, notices market structure similarities, begins systematic liquidation in July. He reduces equity exposure from 40% to 5% between July and September. The price-to-earnings ratio reached 23.1 in August 1987, the highest since 1929. Corporate insider selling hit $1.3 billion in Q3 1987, equal to $3.2 billion in today's dollars. The market crashes October 19th, exactly 78 days after Jones begins liquidation. His fund gains 62% that month. The average investor didn't see it coming, but the smart money had been selling for 3 months straight. November 2006. John Paulson creates a dedicated fund to bet against subprime mortgages. May 2007. Goldman Sachs CEO Lloyd Blankfein orders the proprietary desk to get closer to home. Paulson raises $3 billion for his Credit Opportunity Fund. Goldman reduces subprime exposure by $10 billion between May and August 2007. Buffett's Berkshire Hathaway accumulates $44 billion cash by Q2 2007. Corporate insider selling in 2007 reached $8.3 billion, a record that stood until 2025. The ratio of insider selling to buying, 5.2 to 1, the highest since 1929. While CNBC hosts were calling for Dow 15,000, billionaires were liquidating at the fastest pace in 78 years. Q1 2025. Warren Buffett sells 50% of his Apple position, 25% of Bank of America, and reduces Chevron holdings by 40%. Public explanation: valuations. Berkshire Hathaway's cash position reaches $334 billion, 29% of total assets, the highest percentage allocation to cash in company history. Bill Ackman sells 30% of portfolio holdings between December 2024 and March 2025. S&P 500 insider selling in Q1 2025, $15.7 billion. Sell-to-buy ratio, 6.8 to 1, the highest in recorded history. CEOs of 47 S&P 500 companies sold personal holdings in January alone. The Buffett indicator, market cap to GDP, stands at 197%, higher than 1929 at 120%, higher than 1987 at 88%, higher than 2008 at 135%. But liquidation alone doesn't explain how they multiplied wealth during the crash. That requires strategy too, the preservation play. While they're selling stocks, they're simultaneously buying something else, something that has surged during every single crash for the last century. September 1929. Bernard Baruch begins accumulating physical gold bars, storing them in private vaults. In times of panic, people want something they can hold. Baruch converts 40% of his cash position into gold at $20.67 per ounce. When Roosevelt revalues gold to $35 per ounce in 1934, Baruch's position gains 69% while stocks are still down 60% from peak. Between October 1929 and 1933, gold ownership increased 340% among high-net-worth individuals. Central banks accumulated 4,200 tons, the largest four-year accumulation period on record. Stocks fell 89%. Bonds defaulted. Real estate collapsed. Gold maintained and then increased in value. While banks were failing, Baruch's gold position was untouchable. August 1987. George Soros increases gold mining stock positions by 300%. Quantum Fund accumulates $400 million in gold futures between August and October. Portfolio allocation shifts from 2% to 18% gold exposure. Gold prices spike from $460 on October 1st to $502 on October 20th, a 9% gain, while the S&P crashes 22.6%. The crash lasted one day. Gold's surge lasted 6 months, peaking at $550 in February 1988. While 401ks were devastated, gold holders actually profited from the panic. November 2008. John Paulson launches a dedicated gold fund, the largest gold-focused fund in history at $5 billion initial capital. He converts 20% of his $15 billion subprime windfall into physical gold and gold mining stocks. Gold rises from $869 in October 2008 to $1,895 in September 2011, a 118% gain. Gold mining stocks gained 340% in the same period. While the S&P takes 5.5 years to recover, gold reaches new all-time highs within 33 months. Paulson made $15 billion shorting mortgages, then made another $5 billion buying gold, using the same crash twice. February 2025. Ray Dalio publishes an essay titled Why Gold Should Be 15% of Every Portfolio. Bridgewater Associates increases gold allocation to 18%, the highest in firm history. Central banks purchase 3,200 tons of gold in 2024, the third consecutive record year. China adds 320 tons, India 180 tons, Poland 130 tons. Stanley Druckenmiller reveals a 20% gold position in his Q4 2024 filing. Gold hits $2,850 per ounce in March 2025, an all-time high. Gold ETF inflows. $47 billion in Q1 2025, the largest quarterly inflow since inception. This is happening while stocks are at record highs, not after a crash. The positioning is preemptive, not reactive. But preservation isn't enough. The third strategy is where generational wealth gets created, the asymmetric profit play. Strategy 1 protects you. Strategy 2 preserves wealth. Strategy 3 makes you rich. And it requires betting against the system itself. September 1929. Joseph Kennedy begins short-selling overvalued stocks through private accounts. Kennedy shorts Radio Corporation of America at $105, shorts General Electric at $396. Costs him $50,000 in premiums over 6 weeks. RCA falls to $2.50, a 97.6% decline. GE falls to $8.50, a 97.9% decline. Kennedy's $50,000 bet returns an estimated $4.2 million. His timing was near perfect. He entered short positions 38 days before the crash. September 1987. Paul Tudor Jones purchases put options on S&P 500 futures. He allocates $2 million to put option premiums, 3% of fund value. Strike prices 10 to 15% below market. On October 19th, the S&P falls 20.47%. Jones's put options return $50 million, a 2,500% gain on the position. His total October return, positive 62%. He made $100 million in one day. Michael Burry reads through hundreds of mortgage bond prospectuses, discovers systematic fraud, creates custom credit default swap contracts with banks. Scion Capital spends $50 million on CDS premiums over 24 months. Investors are furious. Burry locks the fund, refuses withdrawals. When subprime mortgages collapse, CDS contracts surge 10,000% in value. Burry's $50 million investment returns $720 million. John Paulson's $1 billion CDS bet returns $15 billion, a 1,400% gain. Burry was paying premiums for 32 months before the payoff. Most investors quit before the trade worked. January 2025. Bill Ackman appears on CNBC, states we have positioning that would benefit from significant market disruption. Pershing Square's filing shows $4.2 billion notional value in S&P put options. Carl Icahn increases his put position to 40% of portfolio, his highest defensive position since 2008. VIX call option volume up 340% year-over-year. Credit default swaps on commercial real estate surged from 100 basis points in 2021 to 620 basis points in March 2025, a 520% increase. Office buildings sitting 40 to 50% vacant due to permanent remote work. Mortgages issued at 3% interest rates must be refinanced at 8%. The math doesn't work. Defaults are inevitable. These bets are being placed while the S&P is above 6,000. The positioning is anticipatory. The three strategies are fully deployed. Strategy 1 removes downside exposure. Strategy 2 preserves purchasing power during currency debasement. Strategy 3 profits from panic. We are currently in months 6 to 12 of the 12 to 18-month pre-crash window. Expected crash window, Q4 2025 through Q2 2026. The S&P falls from 6,200 to 3,500 or 4,000, a 43% decline. Then comes the fourth strategy. After the three strategies pay off, billionaires redeploy at maximum fear, buying quality assets at 50 to 70% discounts. Kennedy bought real estate in the 1930s that quintupled by 1945. Jones deployed capital in November 1987 that tripled by 1989. Paulson bought distressed assets in 2009 that became the best investments of the decade. The pattern isn't secret. It's documented across congressional hearings, SEC filings, and quarterly reports. But knowing the pattern and acting on it are different. Most people can't execute this pattern perfectly, but understanding the pattern gives you enormous advantage. You can execute simplified versions. Strategy 1. Raise cash. If you're 60 to 70% invested in stocks, reduce to 40%. Hold the difference in cash or treasury bills. When the crash comes, you'll have 30% protected. That becomes buying power at the bottom. Strategy 2. Buy gold. 5 to 10% of your portfolio in physical gold or gold ETFs. When the Fed prints unlimited money, gold will surge. This preserves purchasing power. Strategy 3. Buy protection. Buy put options on SPY expiring in 6 to 12 months with strike prices 10 to 20% below current levels. You'll pay 1 to 3% of portfolio value. If markets crash, those puts could return 5 to 10 times what you paid. The most important thing is psychological preparation. When markets are down 40 to 50%, when every headline predicts the end of capitalism, you have to be ready to act. Have a list of quality companies you want to own. Apple, Microsoft, Visa, Johnson & Johnson, Procter & Gamble. When these companies are on sale at 50% off, you buy with the cash you protected, the purchasing power you preserved, the profits you made. You buy aggressively when everyone else is paralyzed by fear. That psychological fortitude separates investors who get rich from crashes from those who lose everything. Kennedy had it. Baruch had it. Jones, Burry, Paulson, Buffett, Ackman, they all had it. The willingness to act when fear is maximum. That's the real secret. We are in month 6 to 12 before the crash right now. When the trigger event happens, when commercial real estate defaults cascade or a major bank fails, the crash will accelerate quickly. Markets will fall 20 to 30% in weeks, then another 20 to 30% over several months. The bottom will arrive when panic is maximum, probably mid to late 2026. The S&P will bottom around 3,500. Bitcoin will fall to $20,000 or lower. Gold will surge to $5,000 or higher. That bottom, that maximum fear moment, that's when the fourth strategy happens. You deploy all the capital you protected and all the profits you made, and you buy everything quality at fire sale prices. Then you hold for 5 to 10 years while markets recover and your positions triple or quadruple. The three strategies aren't secret. They're documented historical patterns that repeat because crashes follow the same mechanical sequence. Extreme valuations, excessive leverage, a trigger, forced liquidation, panic. These strategies worked in 1929, 1987, and 2008. And they're being executed right now in 2025 by the smartest investors in the world. Warren Buffett sitting on $334 billion in cash. That's strategy 1. Central banks buying 3,200 tons of gold. That's strategy 2. Hedge funds buying credit default swaps and put options. That's strategy 3. The pattern is playing out in real time. The only question is whether you'll recognize it and position accordingly, or ignore it and hold through the crash, losing 30 to 50% or more of your wealth. Most people will ignore it. They always do. They'll believe this time is different. They'll believe AI changes everything. They'll believe valuations don't matter. And they'll lose everything, just like most people did in 1929, 1987, and 2008. But a small group will see the pattern. They'll execute simplified versions of the three strategies. They'll protect capital, preserve wealth, and profit from the crash. Then they'll buy at the bottom and become wealthier than they ever imagined. The choice is yours. The three strategies have been made. The pattern is repeating. The crash is coming. Subscribe to Finance Evidence. Over the next 12 to 18 months, I'll track every signal, every insider sale, every gold purchase by central banks, every spike in credit default swap prices, every warning sign that the crash is approaching. You'll see the pattern unfold in real time, and you'll know exactly when to execute the three strategies if you haven't already. This is not financial advice. This is pattern recognition. The pattern has repeated 4 times in the last century: 1929, 1987, 2008, and now 2025. The three strategies are the same. The sequence is the same. The outcome will be the same. Position yourself while you still can. Because when the crash comes, when it's already happening, it's too late. The strategies have to be deployed before the crash. And the crash is coming.